Ladies and gentlemen, good day and welcome to DLF Limited Q3 FY23 Earnings Conference Call. We have with us on the call Mr. Ashok Kumar Tyagi, CEO DLF Limited, Mr. Vivek Anand, Group CFO, and Mr. Sriram Khattar, MD, Rental Business. As a reminder, all participant lines will be in listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Please note that this conference is being recorded. I now hand the conference over to Mr. Vivek Anand. Thank you, and over to you, sir.
Thank you very much. Good afternoon to all of you and welcome to DLF Limited Q3 Financial Year 23 Earnings Webcast. Let me start by wishing you all and your families a very happy new year and thank you for joining us today. We continue to witness strong business momentum across all business parameters. I'll start with financial highlights for Q3 Financial Year 23 DLF Limited consolidated results. Consolidated revenue stood at rupees 1,560 crores. Gross margins improved at 59%, supported by a higher contribution of Camellias. EBITDA stood at rupees 542 crores with margins at 35%. Net profit at rupees 515 crores, reflecting year-on-year increase of 35%. This was primarily due to higher JV profit and a continued reduction in the finance cost. Our residential business delivered a strong performance and clocked one of the highest quarterly new sales booking of rupees 2,507 crores, reflecting year-on-year growth of 24%. Cumulative new sales for 9 months financial year 23 stands at rupees 6,599 crores, reflecting a year-on-year growth of 45%. We continue to see a well-diversified sales mix. Happy to share that 89% of our quarterly sales was contributed by new products. We expect this trend to continue as we scale up our new launches. Our luxury offerings, the Grove at DLF 5, Gurugram, stands completely sold out, reaffirming demand for quality offerings at established locations. Sales booking during the quarter for the product stood at rupees 1,570 crores. The second phase of our recently launched product, the Valley Gardens in Panchkula, echoed customers' confidence towards our product offerings in that geography, clocking in sales booking of 540 crores during the quarter. We remain enthusiastic about the housing industry intrinsic growth potential, which continues to be supported by a resilient economy. Our focus remains on creating customer-centric products that provide a distinctive living experience with best-in-class amenities across our established ecosystems. I'll move to cash now. Operating cash flow for the quarter stood at rupees 633 crores. In light of the Hyderabad asset development being pushed back, we have repaid the outstanding capex advance of rupees 582 crores to DCCDL Group out of these surplus cash flows during the quarter. The transaction was largely cash neutral at the group level. Consequently, our net debt decreased to rupees 2,091 crores at the end of the quarter, a reduction of 51 crores from the previous quarter. I'll now move to the financial highlights for Q3 Financial Year 23, DLF Cyber City Developers Limited consolidated results. The office portfolio continued its gradual path to recovery. Strong momentum across the retail business continues. Rental income grew to rupees 1,003 crores, year-on-year growth of 15%. Consolidated revenue at rupees 1,363 crores as compared to 1,176 crores last year, reflecting a 16% year-on-year growth. EBITDA stood at 1,061 crores, year-on-year growth of 16%. Net profit at 358 crores, reflecting a year-on-year growth of 27%. Occupier attendance across the portfolio continues to inch upwards with gradual recovery across the office segment. While global headwind continues to persist, leading to a challenging environment, we expect demand for quality office assets at established locations should continue to garner interest of larger occupiers. New developments across DLF, Downtown, Gurugram and Chennai remains on track. Planning for our upcoming retail destination Mall of India at Gurugram is in advanced stages. The retail business continues to exhibit healthy growth. Consumption trends continue to reflect sustained momentum with sales delivering consistent growth leading to a healthy retail business outlook. We remain well positioned to achieve our business objectives, which are strongly supported by continued housing demand, quality offerings, and a healthy balance sheet. Right? Thank you for listening to me, and we can now open the floor for the Q&A session. Thank you.
Thank you very much. We will now begin the question and answer session. To ask an interactive question, you may click on the toolbar on the bottom of the screen and click on Raise Hand, or you may click on the Q&A tab on the left-hand side of the panel and click Raise Hand. Accept the pop-up prompt on your screen when your name is announced to proceed with your question. Please unmute yourself before you proceed with your question. To ask a text question, you may click on the text tab available on the top on clicking the Q&A type and type your question. For participants connected via audio call, you may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have a first question from the line of Saurabh Kumar from JP Morgan. Please go ahead.
Hi, am I audible?
Yeah, hi Saurabh.
Yes,
yeah, we hear you.
Yeah.
A little.
Okay. Hi.
Please.
Okay. Thank you. Thanks, guys. And great print for pre-sales in the quarter. I just had a few questions, sir. First is on this DCCDL settlement. So, is there anything left, or are we now fully done on this? And as a consequence of this, should the interest cost of the P&L now further come down? So that was. I can give all of them together, and you can respond.
Yeah, you can just we'll answer all of them together. Yeah.
Okay. The second one was, sir, essentially on this mortgage rate. So we are now seeing a 9% trend, and probably will go to 9.25. So have you seen any early trends of reduction in footfalls in terms of site visits? The third is essentially around this, the golf course extension project. I am seeing a value of 7,500 crores for this project. So I just want to know what is the average price you are assuming for through cycle for this project. And lastly, on DCCDL, does the rental now include Midtown, the downtown? Sorry. So at that 1,060 crore EBITDA include downtown, and also if you can talk the rental progression at DLF kind of years. Thank you. Thank you.
Okay. Yeah.
Thank you.
So Saurabh, thanks for your questions. Let me take it one by one. So this DCCDL settlement of 582 crores, which is a cash settlement during the quarter, this completes all settlements. So there is no outstanding or capex advance in our books as on 31st December 2022. Right? I think that was the first question. That's right. I'll move on. On the mortgage rates, your question was that are these
the PHS will on a settlement now because you were paying some interest on this 2TC.
Yeah. We were paying some interest on that. So that interest we made this settlement in October. So post October, there is no interest on that. So you will see that reduction thereafter. Yeah.
Okay. Right.
Okay. And on mortgage rates, yes, they are now close to 9% and in some cases upwards of 9%. So your question is, are we seeing an impact on the footfalls? Right. So at this point in time, if you really look at our sales numbers, I think the kind of response we've got in the last quarter, especially the two launches we had, right, we are not seeing any significant impact of that as of now. Right. The third one was the sectors 63 group housing. So what we had indicated to you will be the launch value of 8,000 crores during this quarter. right? So that's coming largely from two projects. One is Sector 93 and 63. And at this point in time, I think we are still in the process of finalizing the launch, including the pricing. But the total square feet I can give you, right, which is the launch, is around 4.4 million square feet for Sector 63. Yeah.
Got it. Okay.
Right.
Yeah.
And
Okay.
last part was DCCDL rental of 1,003 crores. Does it include downtown 2 and 3 rental? The answer is yes.
No, let me, if I can
Yeah,
help you
please,
with
please.
little. So we received the occupation certificate for downtown 2 and 3 end of June 22, and thereafter the tenants took possession and started the fit outs. So the first rental started trickling in from November. So what we have in the December quarter is a very small portion.
Okay.
This will be much higher in the March 23 quarter, and will then sort of stabilize in Q1 of next year to its completeness. For your information, it's the buildings are building 2 and 3 are completely leased, and the rental will be for the entire 1.65 million, except to the extent of one or two floors which are on hard options with a multinational company.
Okay. So we are, I mean, you've already achieved your 4,200 crore exit NOI this year. I mean, you pretty much
Yes,
will do
I,
that.
I was sort of going to explain that by asking that we should be able to make 4,200 this quarter.
But next year we should then hit that 45, 46 mark pretty easily, I'm guessing.
Yes, I would tend to think.
Okay. Thank you, sir.
Thank you.
So, Saurabh, sorry, only one more clarification on the DCCL advance. You are correct that the advances as of today are completely settled. However, as you are aware, the genesis of this advance was that DAL has an ongoing arrangement for about 15 years with DLF, where DLF constructs the SEZ buildings and transfers to DAL. However, to ensure that DLF is not out of pocket, DAL traditionally advances that money to DLF. So right now, since Hyderabad was delayed, this outstanding advance has been refunded back completely. As in when a new building comes back on the anvil, maybe a fresh advance would be taken from DCCDL.
And thank you, sir. Just one thing: 6 million square feet of DAL is still left to be delivered by DLF to DAL.
Yeah, I don't have the exact numbers, but yes, between Silokhara, between Hyderabad, and yes, you're right. Approximately, yes.
Okay, thank you.
Thank you.
Thank you. We have our next question from the line of Kunal from CLSA. Please go ahead.
Yeah, hi. Good evening. Thanks for taking the question. So firstly on the
Sir,
leasing
your voice
side,
is
right?
breaking.
We can see.
Mr. Kunal?
Am I audible?
Yes, please go ahead.
Yeah. My first question was on the pre-leasing that we have done in phase 2 Gurgaon, phase 2 downtown Gurgaon of 0.7 million square feet. Can you give us some color on the nature of the tenant and the demand here?
Yeah, so this is what we call Block 4 in downtown Gurgaon. This is a building of about little in excess of 2 million square feet. 700,000 has been leased to, I can give you a flavor, to two large global capability centers in the banking, financial services, insurance. They are two the bigger ones, and then there are 2-3 smaller deals.
Sure. In the same breath, just wanted to check with you, Mr. Khattar, on how is the demand situation considering the global layoffs and the bad news that is happening globally. What's the indication that your existing occupiers as well as the new occupiers that you would be in touch with? What's the indication that you're getting there?
So I can give you the indications. The indications were getting to be quite strong in the month of October, but thereafter with this US recession and continuous hardening of interest rates has dampened the sentiment marginally. and it has dampened the sentiment in terms of the decision makers wanting to defer their decision by a few weeks or months before the situation in the US becomes clearer. However, India's cost competitiveness in terms of its highly qualified English-speaking engineers on one side and global quality real estate at very competitive price will always be a compelling reason for international companies to keep coming to India. And that trend continues. We also see that the movement is to developers who are able to provide grade A++ places, not only grade A spaces, and provide spaces which are scalable for the potential tenants in the future. In addition, the international tenants, when they first come, they don't start with the physical structure of the place or the financials, the commercials. They start with the areas of safety, sustainability, wellness, infrastructure, and what we have done to ensure that their employees are much more comfortable. The fifth and the last trend, which I personally find quite heartening, is this whole work from home is slowly coming to an end. Now, whilst hybrid will happen, but this leverage which at least in the ITS sector, the employees had on working from home is now being looked upon rather unfavorably by the large tenants who are asking their employees to come back, albeit in the hybrid mode. Now, this augurs well for our offices business going forward.
How have the physical attendance been in this quarter?
The attendance varied between various IT parks, but just to give you a flavor, we are at about 60% attendance in Cyber City Gurgaon, 60, 62, 65%. And in Chennai, we are at about 90%, and Hyderabad is around 30 odd percent.
Sure. Okay. And my second question was on this quarter's sales, about 2,200 crores came from new products. If you can break it down between projects, I understand 1,500 crores would have come from the Grove, and what would be the contribution from Panchkula, and what came from the rest?
Yeah. So hi Kunal. So you're right. So Grove is 1570 crores. Valley Gardens Panchkula is 540 crores. And there are others which are independent floors, which is 120 crores. That's broadly the construct.
Sure. That's helpful. Thank you so much.
Thank you. We have a next question from the line of Mohit Agarwal from IIFL. Please go ahead.
Yeah, thanks. So couple of questions. So first is on the cash flows. Your current construction spend annually is about 1,200 crores against a collection of about 5,000 crores run rate. So I'm assuming next year we move up on the collections run rate, considering for the last 2 years we've been doing more than 5,000 crores. So what kind of increase in construction cost do you see? Is it going to be proportionate? So broadly, are your operating cash flow margins going to be similar in the range of around 45%?
Okay. Yeah. Thanks, Mohit. So you're right. Let me just start with the collections first. So in the first 9 months, we've collected 3,722 crores. So on a full year basis, you are right, we'll be collecting upwards of 5,000 crores, right? And that's almost an increase of 20% versus last year. Now, moving on to the construction. So first 9 months, we've spent 974 crores to be precise, including CapEx. And on a full year basis, we expect that this number will be close to 1,400 crores this year, right? The other part of your question was, what is our estimate for next year? So our collections, hopefully, I think by the time we exit this year, our collections will be close to 1,500 crores a quarter. So we should be able to sustain that next year. And our construction outflow for next year, as we are scaling up, will be somewhere close to 1,800 crores.
Okay, and this includes the capex as well.
That's right. So I've
On
given
the
you
rental
like
assets as well. Yeah.
right 1,400 this going
Okay.
up to 800 to 1,900 next year.
Okay, sure. My second question is on getting a little bit clarity on the launches based on the data shared in the presentation. So you're supposed to launch about 3 million square feet in the fourth quarter 23, which includes sector 63 2 million square feet. And could you clarify what is the 0.8 million square feet of premium value homes? And also, if you could elaborate a bit on next year, launches of premium value homes of about 4.4 million square feet, and also the luxury housing of 3 million. And does it include any of phase 5 launches?
Okay. So let me start with quarter four. So quarter four, your first question was on 0.8 million, what we are planning to launch. This is Sector 93 Garden City Enclave independent plots. So that's something which we are planning to launch during this quarter. So we are in advanced stage of getting the approvals. Then what is there as 2 million in luxury housing? That's group housing, the 63, and that's a total of 4.4 million square feet, of which we are considering 2 million to be launched this quarter and the balance hopefully next financial year. Right, so that completes quarter four. The next year, yes, there are a lot of launches which we have planned across geographies and across segments. So at this point in time, I'll say that the number is 9 million, but I can broadly indicate to you that yes, we are looking at launch in one group housing in South, one in DLF 5. But more details we will be able to share when we come back to you in May after the annual results.
Okay, and is there a phase 5 launch in 24 plan?
That's what I said.
Like Crest 2?
All those details we'll be able to share right sometime in May. So we are working on it. At this point in time, I think I can only say these are indicative numbers, but we'll be able to confirm you in May.
Okay, sure. I just have one more question. On the Midtown project, what is the plan there? We've not seen you releasing inventory for the last 2 quarters. So if you could share your thoughts there.
Yeah, that's as per plan. So as of now, what I can say is that structure is ready. So out of the total potential sales value of 4,500 crores, 2,600 crore has been sold. So the structure is ready as we speak. So now we are in the stage of really, right, giving the finishing to the building, and that's expected. That's going to take some time. So possibly at this point in time, the way we see it is that we will be bringing that remaining inventory of close to 1,900 crores sometime in the market middle of next year.
Okay, done. Thanks a lot. That's all from my side.
Thank you, Mohit. Thanks.
Thank you. We have our next question from the line of Sameer Baisiwala from Morgan Stanley. Please go ahead.
Hi, thank you very much, and good evening, everyone. Sir, what's holding back pre-leasing of 1 million square feet at Cyber City and roughly 1.5 million square feet of SEZ, excluding Silokhera?
Sorry, pre-leasing? I don't think we are doing any new projects in.
No, I meant leasing, sir. It's the vacant area that I'm talking about. 1 million Cyber City and 1.5 SEZ.
Yeah, if you see, the vacancy numbers have been consistently coming down since April, and what I have been given to understand that our vacancies are much lower than that of our competitors and peer group. The vacancies are a little higher in the SEZs for reason which you are well aware of, which is the Desh Bail or the amendment to the SEZ, which is taking a little more time than we had anticipated. But I don't think we've now come down to single digits roughly in Cyber City. And Silokhera, there is a perennial problem which you are aware of in terms of a Supreme Court case, where the vacancy is about 32-33%, giving an overall portfolio vacancy of about 10.2%.
So if you recall, Sameerji, the vacancy levels had risen to 15% plus at the peak of COVID, and they are declining gradually quarter on quarter. And now they are at about 10%, as Shriram said. And hopefully, we will continue seeing a decline in the future quarters.
Okay, great. Thanks. I guess what I'm also asking is, what's the walkthrough, versus this year's exit rental and the exit rental in fiscal 24? I can see downtown Chennai as one driver. Are there any other important items that will drive this growth?
So the rentals of FY24, the growth in rentals will be one based on the growth of the existing rentals, which is traditionally what it is for the existing portfolio, plus a full income for the 1.7 million in downtown 2 and 3 in Gurgaon, and a marginal inflow of the rentals of downtown 1 and 2 in Chennai. Because please recall, by the time we get the OC, which is likely to be later, middle of this calendar year, and then the larger tenants who come and do their fit outs, and by the time they start paying rents, I don't think they will be before the first quarter of the next calendar year, which will be the last quarter. But then in the following year, the rental for Chennai will come in full bloom. And in the year after that, the rental for the 2 million downtown 4 will also commence.
Okay. Okay. Very clear, sir. And just on the borrowing cost for DCCDL, how much increase have you seen so far, and how much is left? If you can just talk about that.
Yeah, so I was also quite intrigued to see in this quarter that our interest cost has been constant compared to Q3 of last year, and the borrowings have been constant. And when we went into a little bit of a deep dive, I realized that the interest cost was pretty high in the first 2 quarters of the last year, and then it started dipping, and then it started picking up. Our exit interest cost as of this quarter is 7.85, 7.86. And I personally don't see the interest rates going up beyond maybe 25 basis points further with the current control on inflation that we have. And thereafter stabilize and start probably looking at coming down later part of this year. So in my view, interest rates other than 25 basis points would have peaked. I also say that we've done a reasonably good job in ensuring that we are very competitive when we borrow. And therefore, the interest rates, the hikes that have been taken in the repo rates, etc., the rate of increase of our interest rates is far lower than that.
Okay. No, that's good to hear, sir. If there's only 25 bips left, so that would be a pretty good outcome. And one final question. DLF has roughly 2.2 million square feet of rental assets like Kolkata SEZ and Chanakyapuri Mall, etc. So what's the thinking over here? You want to keep all of this, or you want to monetize some point in time in future?
So Sameerji, obviously, I mean, there's no intent to monetize it on a standalone basis. At some stage, as and when there is a eventual capital solution around the entire cybersecurity piece, if it makes sense, some of these assets could flow into that. But that's again something for the future. Right now, we are focusing on sort of while it's being managed by a common platform, which is the Mr. Khattar's platform. The ownership is still separate between cybersecurity and DLF. But at some stage in the future, they could be integrated, but I think it's still speculative right now.
Okay, got it. Yeah, thank you.
Thank you. We have our next question from the line of Pritesh Sheth from Motilal Oswal. Please go ahead.
Hi, sir. Thanks for taking my question. First is on again on Midtown, just to follow up from previous participants. So, the release of I think the Tower D will happen sometime in first half of this year, as you said. In that sense, do we think that the second phase of One Midtown probably might not get launched in FY24?
Yeah, FY24, where I don't think it will be launched in all fairness. Also, frankly, we have a fairly rich, launch pipeline. So I don't think we want to crowd it any further by having the Midtown, I mean, the next phase of the Midtown project being launched. But as was, I think, mentioned by Vivek, that sometime in the middle of this year, we should hopefully have the residual inventory of Midtown, be released for launching.
Sure, got it. I mean, the launch was still reflected in our presentation as FY24. Just wanted to clarify that bit, but thanks for that clarification.
Yeah. So Ritesh, you are right, and that's the reason I didn't comment on the launches for 23-24. What I clarified is when we come back to you with annual results, we will give you more details for our launches for next financial year. And you are right. This 2 million of residential JV Central Delhi, this will undergo a change.
Sure, got it. And one on downtown Gurgaon, our occupancy has dropped from previous quarter to this one, from 98, 99% to 93% right now. And even in place the rent that is reflected in our presentation, it was last quarter around 136 odd rupees per square feet. Now it's showing 120. So just wanted a clarification on that. I mean, why we saw a drop in drop in occupancy and drop in rentals as well.
I don't think there is a drop, but we will come back to you with this. We will answer it on Monday for you.
Yeah, we noted this, Ritesh.
Sure, no problem. Thanks. That's it from my side. All the best.
Thank you. A reminder to participants, to ask an interactive question, you may click on the toolbar on the bottom of the screen and click on Raise Hand, or you may click on the Q&A tab on the left-hand side of the panel and click Raise Hand. Accept the pop-up prompt on your screen when your name is announced to proceed with your question. Please unmute yourself before you proceed with your question. We have our next question from the line of Puneet Gulati from HSBC. Please go ahead.
Yeah, thank you for the opportunity. My first question is on Panchkula. That seems to be, doing quite well. You're selling 500 crore each quarter now for last 2 quarters. What kind of potential do you see there, and how deep is that market?
So Puneet, I mean, it's an intriguing question in a sense that we ourselves have been frankly very pleasantly surprised by the depth that Panchkula has demonstrated. They really, I mean, as you may or may not be aware, some of this inventory was actually a slow-moving, plotted inventory with us for a very long time, and frankly, the bounce back has been fairly spectacular. We obviously have some further inventory, am I right, Vivek, in Panchkula, which we'll hopefully continue selling. Eventual market size, I think it will take some time for us to fully fathom that.
But just to give you some, Puneet, right, the total project size is 2.2 million square feet in Panchkula, what we've launched, of which the inventory what we've released in phase 1 and phase 2 is 1.4 million square feet. And I can share with you, we got a very good response, of which out of 1.4, 1.3 million square feet has been sold, and at a sales value of almost close to 1100 crores, and we've realized 8400 rupees a square feet. And the balance inventory, right, hopefully should get released in early part of next financial year, and hopefully should get sold.
Yeah, so can you give some color on who are, what kind of buyers are these? Are they investors, end users? And the realization also seems to be quite, good and surprisingly high as well.
The realization is good. It's about 8,000 rupees plus per square feet, in that sense. The ticket size is also almost running to 3 crores plus. So a lot of them are people who belong to that place. I mean,
Yes.
This question about investor and end user is a very confusing one always, because obviously for many of them who are buying, it may be a second house that they are buying, not necessarily their first house. But they're not, I'm sure they're not buying it only for speculative purposes. There are a lot of retired government officers, retired military officers who belong to that area, who are looking at, a nice sort of, enclave to eventually settle down. I think it's a mix of all of those. But to your first point, the depth has surprised us on the positive.
It's also not main Panchkula, as I understand. It's slightly off Panchkula as well in some sense, isn't it?
But Panchkula is a city of small distances. So,
This is right on the river.
Actually, locationally, this is actually better than the main Panchkula.
Exactly.
What we would normally call the main Panchkula area.
Okay.
Yeah.
That's
It's on the river. It has a great view of the Kasoli Hills. So, it's actually very nice.
Understood. Got it. My second is if you can give some, comment on when should we see the timeline of completion for phase 2, balance capex left, and the downtown Chennai balance capex.
So downtown Gurgaon is a huge development. It's about 12 million square feet, out of which 1.7, which is downtown 2 and 3, is already completed, leased out, and it is now behind us, capitalized in the books.
Yeah.
Downtown 4 of 2 million is under construction. So that takes it to 3.7 million, leaving about 8 odd million, of which 3 million is most likely the retail destination mall, and the balance about 5 odd million will be offices. Our planning for the retail
2 million square feet. Yeah. Sorry.
So our planning for the mall is at a very advanced stage. Now, whether it ultimately comes out to be 2.7 million, 2.5 million, 3 million is really what the architects come out with. And since this is a multi-use integrated development, the planning is much more integrated and has taken a little longer than what we had anticipated. But we are coming to the end of the cycle for the planning of this.
Yeah. Okay. So for the 2 million square feet phase 2 for downtown, the fourth block, what is the balance capex and timeline for completion?
So there we are planning to have the OC readiness by the Q2 of FY24. FY25.
And balance FY25. Okay. And capex to complete?
Capex is a standard. It's about I think about 750 odd crores. Balance capex.
Right.
Also,
for Chennai, the three. Yeah.
Sorry, I mean, in the cybersecurity business, unlike DLF business, capex is a continuous learning stream, in that sense. Actually, the day capex stops, it's really death, frankly. So right. The downtown. I mean, this kind of downtown will end by that time. Hopefully, the malls would have begun. By that time, the first phase of the next 5 million square feet will begin. So downtown will continue to be hopefully a significant consumer of capex for the next 5 to 6 years.
I understand that. But for the Chennai downtown 3.3, which is under development, what is the timeline there? And
so there we should be ready for the OC in the next quarter.
Okay. And substantial money is spent already, I presume, right?
Yes, I would tend to think that typically in a project like this, what happens is that the last 6 months you spend about 40-45% of the funds. So about 60-65 would have been spent, and the balance 35 would be there in terms of the cash flow.
But if you can quantify the balance amount as well, the 40%, which is left?
Million into about 300-350 crores.
Okay. That's very helpful. Thank you so much. And lastly, if you can comment on, the competitive intensity in the Gurugram market. The commentary seems to be a lot of new players are rising. The old ones who once we thought were dead are also rising back. What do you see there in the market?
See, this is a typical market cycle where when the rentals tend to stabilize and move, you will find a few more entrants coming into the market. But the people who are coming into the market are putting up buildings which are less than 1 million square feet each. And these buildings are unlikely to give scale to the larger tenants who want to take up spaces. So yes, they will have a market, but the market will be for smaller corporate offices and not for the larger global companies and the group capability centers who will still look at much larger developments for their needs, which are in terms of size much bigger than these smaller ones. So while this competition will be there, I think we are quite confident of sort of facing them and continuing our journey of growth as we have given the guidance or as what we plan.
And similarly, if you can comment on the competitiveness on the residential side.
So frankly, on the residential side, the market actually is right now in expanding mode. From a scale standpoint, the fact is that there's possibly one major player in Gurgaon apart from us who is sort of going at a strong pace, and at least we are not seeing any influx of any bigger players of size and scale coming here. There are obviously one-off projects by a number of players, both original Gurgaon players as well as players coming in from Mumbai and other places. But that's the way it is. Right now, the market is clearly in a zone where it can expand and can sort of absorb more supply.
And if I were to add, I think demand continues to grow in Gurgaon market. I think the supply is all-time low, right? So at this point in time, in fact, NCR continued to be the highest holding inventory almost 5 years back. Today, if you look at the supply in Gurugram in particular, it's close to 12 to 15 months. So I think that's one shift which has happened. And if we look at DLF market share by value in Gurugram amongst the top 10 players, we've actually grown our share to almost double, and the last reported share is 30%. On the pricing, we are seeing, especially again in NCR market, in the last 1 year, we've seen a healthy pricing growth of upwards of 20% versus a national average of close to 10%.
Yeah, if I may please add to that. See, in the renting business, we don't look at a market. We always study our competition in a micro market. Honestly, the market in which we operate, say New Gurgaon or Sona Road, doesn't fall into this market segment at all.
Okay. That's helpful. Thank you so much and all the best.
Yeah, thank you.
Thank you. We have our next question from the line of Sameer Baisiwala from Morgan Stanley. Please go ahead.
Thanks for the follow-up, but my question has been asked. Just a quick one. Any thoughts on Camellias and also broadly 3,000 crores of finished good inventory? What's the visibility of selling this down? Thank you.
So Camellias inventory out of 3,000 crore as of now, as of end December, is 1,700 crores, and that's almost, to be precise, these are 46 units. And during the December quarter, we have sold 4 units. And if I look at the average run rate of last 1 year, it's close to 8 to 10 units every quarter. So we expect with the price increase we've taken, right, the pace at which we've been selling will certainly now stabilize at 5 to 6. So this will take at least 2 years for us to really liquidate. So that's one. In terms of the other inventory, which is around 12 to 1,300 crores, I think a large part of it is in National DevCo, which is sitting across almost 20 projects in Tri-City, in Delhi, in South. And this is residual inventory. And just to give you some numbers, 3 years back, this inventory was close to 2,500 crores, which now has been, in the last 3 years, through our focused efforts, we will be able to bring it down to close to 1,200 crores as of end December. So our estimate is that this will take another 2 to 3 years before we will be able to liquidate this.
Yeah, very clear, sir. Thank you.
Thanks.
Thank you. We have our next question from the line of Saurabh Kumar from JP Morgan. Please go ahead.
Yeah, thank you for this follow-up, sir. So the first question is, specific to your asset Saket. So I noticed that your rental is, close to that 160 odd mark. What will be the real reason why the differential versus Select would exist in your view? Select is like near 500. So that's the first one, and it's important. So you know why. The second, sir, is essentially on this Gurgaon. Your pricing has gone up quite a lot, but when I look at your disclosures, the gross margin is coming to about 45% odd. So I just was, because we always targeted a gross margin of about 50%. So I was wondering why. Is there some like low value sales you've done to kind of liquidate old moving stock? So that's the second one. And the third is on DCCDL again. So the accounting would have allowed you to straight line the rentals in this quarter, right? So was there a straight lining impact which would have flown through in this quarter? Maybe not from a cash perspective, but from a reported EBITDA perspective, it would have happened.
Yeah, so I'll start with the Saket Mall versus this. So I think what you would maybe referring to is you're comparing the figures that have come in the draft DRHP. First of all, in my reckoning, those figures are for FY24 or FY25. They are projections. Whereas what you're comparing it with is what you have for the current quarter for FY23. So that's one sort of gap that you have. Secondly, as you know, that as a commercial loading, we have 100% loading. I am given to understand that Select's loading is much, much less. That's number two. Number three is that for us, it includes the back block, which is basically the cinema and a few restaurants. Whereas, to my understanding, Select City sold its back block completely, and therefore the lower rentals that you get for the back block do not come here. There would be other reasons, but I think these three should suffice for the time being. As we, we've not had a year to stabilize in Saket, because the moment we rejuvenated the mall and enhanced it and opened it, COVID hit us. And I think it's been a rather, how would I say, challenging journey on this till now. In the coming year, we've already seen an uptick in the last quarter in the earnings and the footfalls and the trading densities, etc. And I believe that we'll continuously witness it. It is our experience that a mall comes to full glory of proper sustainable income after one or two proper seasons that it has seen through.
Got it, sir. Okay, but your incremental rentals will be similar, right? Like on incremental leasing, it will be.
Yeah, our incremental rentals in Saket would be quite decent. I don't know whether they will be similar to the Select, because I do not know what their incremental rentals would be.
I think you know, but it's fine. Okay. Second is, sir, basically on this DCCDL accounting. So was it a straight line impact?
So on the straight lining, Saurav, as usual, your questions are quite incisive. So on a pure cash rental basis to an accrual in the PL, the difference is about 100 to 150 crores in the year, which is basically because of the straight lining.
No, I'm saying for this quarter, your downtown would have got straight lined into the EBITDA.
40 crores is what it is for this quarter.
Okay, got it. And sir, lastly on this, Vivek, on this gross margin.
Yeah, I'll take that. So gross margin, yeah, you're right. So it's of the 12.5 million products what we've launched in the last 2 years, yeah, our margins are somewhere close to 45%. Now it is because of course, the mix, right? So let me start with the 2.8 million square feet, which we've launched in DLF City and Phase 5, right? So that is 2.8 million, where our average price realization is upwards of 17,000 per square feet, and our margins are close to 50%, right? That's one. Now we've launched again low-rise floors, which is close to 5.7 million square feet. We've launched in New Gurgaon and Panchkula put together, and there our average realization relatively is low at 8,300 rupees a square feet, and our margins are around 35%. And one Midtown, phase 1, what we've launched is 2 million square feet, where our margins are around 42%. So if you take a weighted average of this, right, you will get close to the number what you have. Right? So broadly, that's what the construct is. So answering your question, it's a mix of the different products we've launched across segments and across geographies.
Mr. Saurabh Kumar?
Yeah,
Mr.
sir,
Saurabh Kumar?
just to continue this train of thought. So as your pre-sales stabilize on your P&L in terms of revenues, in terms of the operating leverage, because I'm guessing you're spending a lot of overheads on your brokerage marketing, which is hitting P&L today, which will probably not happen as these sales stabilize. So we should expect margins to kind of move to that 35% plus mark over next 2 years as your revenues catch up to pre-sales.
Yes, that's right. Once I see today, if you really look at my revenues, what I'm booking is 14 to 1500 a quarter, and what I'm selling is 2000 crores a quarter. So there is a gap of almost 25%. I think this will take some time before what I'm booking and what I'm reporting as my revenue catches up, right? So
yeah, so
once
the incremental
rate, right, you will see the EBITDA margins really inching upwards to 35 plus levels.
Yeah, so the incremental revenue will come at 45% margin, but the fixed costs don't go up because the brokerage and stuff. Understood. Thank you.
Thanks, sir.
Thank you. We have a next question from the line of Abhinav Sinha from Jefferies. Please go ahead.
So thanks. My margin question has been answered. Second question which I had was on the independent valuer number which has been put for DCCD and GAV. Now this seems to have moved up by 10% QOQ, both for offices as well as retail, and while the rental seems to be roughly stable. So any comment on where this could have come from, the increase in valuation?
Well, these are numbers which are given by independent valuers, and they are taken from the report and then mentioned. And I don't think I would like to comment on what valuation has come from credible third parties.
But to some degree, I think the reduction in the inventory levels, the vacancy levels, and the gradual completion cycle of the downtowns, etc., starts having a bearing.
A lot to do also with the overhang now of the COVID.
Yeah,
because that they had not factored in, and in this quarter now they have taken that.
So gradually the values have now begun sort of reducing the overhang of the COVID that was there for the last 2 or 3 years.
Okay. Okay. Thanks. So secondly, any thoughts and updates that you can provide us on the plans on entering the Noida or Mumbai market, which may have made some progress during the last few months?
So on Noida, the answer I have is that no. Zero progress since we spoke last. On Mumbai, clearly, we continue to try to work with the concerned bank and our joint venture partners in trying to find a solution to the Mahalakshmi project that we have, Tulsiwadi. We still are struggling to get everybody on board, in a manner that the project can take off. We are in conversations on potentially, one more project in Mumbai, but as and when, it's sort of nearer closure, we will hopefully make an announcement on that. But as we speak right now, nothing further to report than what we had last quarter.
Thank you, sir, and all the best.
Thank you.
Thank you. We have our next question from Mr. Pritesh Sheth from Motilal Oswal. Please go ahead.
Yeah, thanks for the follow-up. Even I have a question on Noida, but just very specific. Recently, I think we have had few auctions happening in Noida where we didn't participate. So just wanted to understand your thought process whether the margin profile that we are looking at is it lower than what we are getting for, or what's the thought process?
So two issues. One is obviously, the price points at which those biddings and all started, while obviously, if one is desperate, one can obviously participate in those, but I don't think that we needed to be in those with those price points. Noida comes with its own set of conditionalities in these public auctions, including potentially, a future unquantifiable liabilities around compensations and those sort of things, which frankly make participating in Noida public auctions, a slightly dicey process. So we want to be very careful, before we participate in one. None of the auctions in the recent past were tempting enough for us to participate.
Got it. And just last, your deliveries for the floors that we have been launching since last year, I mean FY22 onwards, will we see that start happening in Q4 of FY23, or that largely FY24?
Yeah, so we are trying our best that we make a beginning this quarter, but for sure it will start from Q1 of next financial year.
Okay, and on 1 mid is 25?
Yeah, that's right.
25. Okay. That's it from my side. Thank you.
Thank you. We have our next question from Mr. Kunal Lakhan from CLSA. Please go ahead.
Hi, thanks for the follow-up again. So just wanted to understand with the Sector 63 launch and the kind of run rate we have clocked in the 9 months, are we revising our sales guidance, or how should we look at full year now?
Kunal, we still have, 65 odd days of the quarter to clock in. I mean, I think we are very confident that we should hopefully be able to meet and slightly exceed the guidance we had given, but we will not like to, substitute the earlier number with the new number right now. Yeah.
Okay, sure. And secondly, with the Mr. Khattar said, he expects like another 25 is increasing the rates and then it should peak out. With the peaking out of rates in sight now, like if you can give any update on the REIT plans or any of that sort.
Sorry, your question is not clear. Sorry.
REIT plans.
REIT plans, yeah. So if you expecting the rates to peak out, what the plan right now?
Hopefully, as the rates start peaking out and then hopefully begin declining, at least the macroeconomic rate-linked uncertainty around the REITs should start gradually melting away. I mean, you've seen that at least some of the bigger REITs have had to take the hits, because of the interest rate cycle, the way it's panned out. And honestly, that's just the nature of the animal, frankly. So hopefully, as things stabilize, we will come back to you with what the plan is. I mean, as you always maintain that our downstreaming wise, we are more or less ready now. I think the last set of mergers should be filed in the next a couple of weeks, I'm told. And then let's just wait for A, the macro, and B, what both the players, specifically GIC, feel about the entire process. And then we'll take a call.
Sure. Thank you so much and all the best.
Thank you.
Thank you. I now hand the conference over to Mr. Ashok Tyagi for closing comments. Over to you, sir.
Thank you so much. So I mean, this has been a good quarter, both on the development and on the rental business. Clearly, the development pipeline and the residential sales continues to be grow at a strong clip. I mean, the home mortgage rates have now gone up in excess of 200 basis points since we began this cycle. But hopefully, it has had a very, very limited impact on the entire sales cycle and the sales optimism. And as we begin, hopefully, reaching the peak of the interest rate cycle, we do look forward to to a good few more years of the entire strength in the residential business. And we, because of our locations and our products that we have, are hopefully well placed to be able to take advantage of it. The rental side, I think the after effects of COVID are now gradually behind us in the retail sector completely, in the offices largely, and the new capex build out is now accelerating, and hopefully as we hit fiscal 23-24, we hit it with a confident stride in both the residential and the commercial side. Our free cash flows on both sides of the equation, Cybercity and DLF, are reasonably strong, and which will continue to be deployed gainfully in terms of strategic capexes and obviously return to the shareholders. And hopefully look back to reconnecting back with you at the end of Q4. Thank you.
Thank you.
Thank you. On behalf of DLF Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Thank you.
Thank you.